Welcome back to Am I Catching a Falling Knife, the show where we dive deep into stocks making headlines and try to figure out if it's an opportunity or a trap. Today, we're setting our sights on Lululemon, ticker LULU. This stock has seen a bit of a tumble recently. Is this a temporary dip for a strong brand, or is there more to the story? Let's unpack it. The current market narrative around Lulu is largely dominated by the fallout from their recent Q2 2025 earnings report. While they actually managed to beat EPS estimates, the company regrettably missed on revenue expectations. More significantly, they slashed their full-year 2025 revenue and EPS guidance. The primary culprits cited? Softness in their U.S. business and the not-so-insignificant impact of higher tariffs. This double whammy has led to a flurry of analyst downgrades and a generally cautious sentiment among investors. Now, what exactly is Lululemon? Well, at its core, it's an athletic apparel and accessories powerhouse. They design, distribute, and retail gear for women and men, covering everything from yoga and running to general training and other sweaty pursuits. While their women's product line makes up the lion's share, about 63% of revenue, their men's segment is a solid 24%, showing good diversification. Geographically, the U.S. is absolutely critical for Lulu, representing over 53.5% of their total revenue, with China also being a significant and growing market at nearly 24%. This context is crucial when we talk about the softness in the U.S. business. Given that over half their revenue comes from the U.S., any significant slowdown there is going to ripple through the entire company. When you combine this U.S. weakness with those higher tariffs, it's clear why Lululemon felt compelled to significantly lower their full-year guidance. We've dug into what this means for their bottom line. A significant lowering of guidance for a company like Lululemon, especially given their operating leverage, isn't just a minor blip. We estimate that this U.S. softness and tariff impact could represent a 4% to 6% reduction in their overall revenue expectations from previous forecasts. Now, here's the kicker. Because of that operating leverage, essentially how much a company's profits grow with revenue, a mid-single-digit percentage hit to revenue can translate into a double-digit percentage decline in earnings per share. Based on our analysis, factoring in their reported gross margin of around 23.7%, we're projecting a material negative impact on Lulu's upcoming quarterly EPS, potentially around a 12% drop relative to previous expectations before that guidance cut. There's a confidence interval here, folks, ranging from a -7% to -17% impact, because terms like softness and significantly lowered guidance are qualitative, and the exact specifics of their guidance revision weren't fully public. So, what does this mean for the stock's valuation? Our base case discounted cash flow, or DCF, suggests a value around $220.01. However, when we adjust our model to incorporate this new, more cautious narrative, specifically that projected 12% impact on future earnings, the fair value estimate drops to about $182.61. The market is clearly digesting this news, as the stock is currently trading around $206.09, which is still above that narrative-adjusted fair value. For those of you wondering about potential entry points, some interesting levels to keep an eye on, according to our custom buy-level analysis, could be around 170, 130, or even 110. These are just zones to watch as the market continues to process this new information. So, to wrap things up on Lululemon, the dominant narrative is clear. U.S. business softness and tariffs are impact future guidance. We're looking at an estimated 12% negative hit to upcoming quarterly EPS relative to prior expectations. While the base case valuation was around $220, when we factor in this negative narrative, our adjusted fair value drops to approximately $182.61. This suggests that at its current price, the stock may still have some downside as it fully bakes in the revised outlook. Remember, those potential buy levels we mentioned are areas to observe for a more attractive entry. As always, this is just our analysis, not financial advice. Do your own thorough research, consult with a financial professional, and make decisions that align with your own investment goals and risk tolerance. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.